Welcome to the Cashflow Project podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cashflow Project podcast. I'm your host, Steve Fieros with Tri-City Equity Group. Today, excited, we've got Joe Viery on the show. Joe's the founder of U.S. Tax Advisors Group, USTM. Hopefully I can say it like that.
That's good.
They've got the goal of providing high quality cost segregation studies, primarily working with real estate investors, although of course Dixons can benefit. Obviously a tons of experience. He's a cost segregation professional, so CSP designation, to help property owners defer or eliminate millions of dollars in income taxes by leveraging IRS compliant cost segregation studies. And guys, I cannot tell you enough. Learn the rules. Play by them. They're written for you. Don't be scared. Use the tax code to your advantage. And Joe's going to help us talk about and dive into how we can do that, especially using cost segregation studies. So Joe, welcome to the show.
Thank you, Steve. That was a great intro. Appreciate it.
Yeah, no, absolutely. I'm glad to have you on. Of course, especially to cost segregation. I mean, we've used extensively on all of our commercial acquisitions. This is something that's definitely available to residential operators, short-term rental operators, which I am as well, and a number of our partners and a number of our listeners. There's changes in what's happening now with cost segregation and that kind of deal. So I'm glad to have you on and talk a little bit kind of the state of the industry and state of where we're going with this. But kind of before we dive into that, give us a little bit about your history. Were you always, since a little kid, working with numbers and, helping guide people through their taxes, or how did you get started?
Here's the difference is that I'm an entrepreneur. So no, I'm not an accountant and I'm not a lawyer. So I'm not going to give tax or accounting advice. But I started out in college, my own company, which was in the travel industry. And I owned that for 20 years. In 2000, I sold and I began working for the California Association of Realtors I was securities licensed, doing financial planning and investment strategies, blah, blah, blah. Well, you know what happened. I'll tell you, prior to 2007, I had a friend of mine who wanted to talk to me about this technique, and he was really excited about it. I thought he wanted to sell me Amway soap, so I blew him off for a long time. Finally, one day I said, okay, let's go have lunch. He told me at lunch about cost segregation. I had two clients who were facing down the barrel of a huge income tax bill, over $50,000. I went back to them and I said, hey guys, do your due diligence, but I think this will solve your problem. It did. And then in 2007-8, the car went off the cliff all the way to the bottom in the California Association of Realtors. But obviously the real estate industry in California was hampered quite a bit. And so I was approached by the owner of the company that I use, and he said, why don't you join our team? You're really good at what you do, enough about real estate and cost segregation. I jumped on board and I got lucky because I guess it's luck. Maybe I made my own luck. But what happened in the beginning was that I fell into a tranche of investors that had a lot of cash. So everybody was suffering and selling and refinancing or losing their properties because they couldn't refinance. My guys were buying it all up. And guess what they had? They had a lot of income taxes. So I started off very busy and I have not slowed down. Started my company about 7 years ago, U.S. Tax Advisors Group Incorporated.
Oh, that's awesome. And I love that too, because of your start. And I love that you kind of preface that. And then for one, none of this is tax advice. None of this is financial advice, you guys. Of course, this is just kind of edutainment, right? This is do your own due diligence in terms of consulting with your proper tax professionals and legal team. But I love that you started off, you preface your conversation with being, hey, I'm an entrepreneur. I'm just like you. I'm just like many of our listeners. And I think that's really important because you're coming from the approach of, hey, I'm a solution finder. As being a business owner, being an entrepreneur, we're in the trenches. We're the ones that are dealing with the challenges of running a business. And then if you're successful, then you do end up with these massive tax problems. I talk to a lot of investors and it's like, more money, more problems, right? Because it's like, well, hey, look, I want to do great in my flipping business, in my short-term rental operations, and our syndication, but awesome, amazing. We're here to see you advance, but you will end up with a significant tax liability the more successful that you get. So you start looking for strategies, things that you can implement to lessen that tax burden. And doing cost segregations. I mean, it's massive. I'm sure you've got plenty of stories of tax savings and how this has benefited. Obviously, your impetus for, or your ramping up period, your starting up period was a good example of that. But I love coming from that entrepreneur background because you know what it's like to be there.
Yeah, and I
It's
know
not a
when you get the news from your accountant that you owe income taxes, it sometimes can be a very, very difficult. You go, wait a minute, I made that much money and I have to pay that?
right. Yeah. You're like, I thought I was doing good. And it's like, well, you are, but that comes with
Yeah.
its own challenges too. Now, I love also too, you've got the insight having started before the GFC. You know, a lot of people kind of newer to the business and they've never seen a cycle, right? They've never seen real estate and kind of does this number, right? That's
Yep.
just part of that is natural. I mean, some of the stuff is black swan and yeah, we can't predict it, but we do know the real estate is cyclical. So adding tools to the tool belt, knowing what's available to you, and just like how your initial partners, they were positioned, sounds like powerfully to be able to take full advantage. We're in that time now too, guys. So maybe there's still opportunities here for you to go back and create some additional income to take advantage of this period that we're in. And I personally think that we'll be in for a little bit. So no, kudos to you. Now obviously we have talking about cycles. We came through COVID. Now we're kind of dealing with some of the fallout from some of that. Do you still see cost segregation playing a vital role into like a current investor's tax strategy, let's say?
Definitely. Here's the big buzz though that's going around, and it's not a big buzz for me because I told you I started in 2007 and we did not have bonus depreciation. Bonus
Yeah.
depreciation came out in 2017, I think it's September 25th, 17, meaning a property acquired after that date could qualify, not all, but around that date, but let's just say that date that couldn't qualify for bonus. So 100% bonus, the last year was in 22. A week from yesterday, a week from Monday, or this coming Monday, is the close of the 22 tax season. That's for proprietors, people who own properties in their name. And so bottom line is now it goes down to 80%. And then in 2023 will be 80, 24 will be 60, all the way down to it'll zero out at no bonus. So I grew up without bonus. It means very little to me because it's a timing issue. That's all it is. I don't use that as a scare tactic, although it's nice. Don't get me wrong. I love 100% bonus. I love 80% bonus, but you're still going to get a big bang from doing cost segregation. It's just that you're going to have to get the big bang over a couple of years. That's the only difference between zero bonus and having bonus is it's going to take you a couple of years to get to the 100% of the tax savings benefit that I will give you. Is that a big deal? Not, in my opinion, not really, because we never had it for the first, 10 years that I was, or
Right.
more that I was doing this. But just so everybody knows, bonus depreciation for 23 is going to be 80% of all of the short life assets that I find. What do we find when we do cost segregation? We find 5, 7, and 15-year property in addition to the real property, which stays in 27 and a half or 39-year property. So any of those short life, anything under 20 years or under qualifies for bonus. And that's what we do. So everything you would get in 23, 80% of what you get in 23 will be qualified for bonus.
Yeah, no. And so, I mean, it's important to understand that. And I actually kind of want to back this up a little bit too, because
Okay.
some of our listeners I know plenty of them are going to know exactly what we're talking about and they're tracking right along. There's going to be a segment though that have no idea what we're talking about. What did I just walk into? Can you back up a little bit and kind of break
Sure.
down just, hey, you know what
Yeah.
is a cost segregation study?
Yeah,
Just so we
you
can
know
get a
what?
little bit more basic.
I do this all the time. It's very easy. What you have is gross taxable income. How can you reduce your gross taxable income? One way is by expenses. And you have a lot of expenses in real estate. One of the powerful is depreciation. What is depreciation? Depreciation is the IRS telling a property owner who owns investment real estate, not their primary residence, but investment real estate, that their property is getting or falling apart or being used up over time. And so rather than waiting until you sell the property, they say, okay, look, we're going to give you the advantage of getting some of this as expenses so you can reduce your taxable income. If you take a 27.5-year property, you take the building basis, which is what you paid for the building less the land, and divide by 27.5 years. A child could do it. Easy peasy. If you have a commercial property, it's divided by 39 years. But just think of the expense. You get a little bit of that expense for the next 27 and a half or 39 years. What we're doing in cost segregation is we're going back to the IRS approved technique, which is them saying that there are hundreds and hundreds of components used in the construction of the building with shorter lives. So what am I talking about? Interior, I'm talking about things like cabinet tops, cabinets, window coverings, specialty lighting, flooring. Those are all 5-year property, 7-year property, furniture's fixtures, 5 or 7-year property. And then I'm talking about the outside of the property, the land improvements. What am I talking about? I'm talking about landscaping, driveways, swimming pools, patios. All of that is 15-year property. And so all we're doing as engineers is we're taking the IRS guidelines. And if anybody can't sleep at night and they want to know, my Bible is the audit technique guidelines for cost segregation published by the IRS. It's a 200-page document. That's my Bible. We do everything according to what they determine is a quality study. We don't cut corners. We don't make up information. We do it the right way. So bottom line is we peel off, our engineers peel off all the components that can be accelerated. And so I'm going to throw out a number to give you an example. So let's just use a round number because every building is different, but let's use 30% accelerated. There are buildings that I can find higher acceleration. There are many buildings I can find lower, but let's use 30. So what am I'm referring to? If you bought a building for $1.2 million and you allocated $200,000 to land, I've got $1 million to accelerate. So at 30%, I'm going to give the owner of that building $300,000 tax deduction in expense that's going to reduce their taxable income. So it's huge, it's big, and we do it for small buildings as well as big buildings. So anybody who owns investment real estate can now get their depreciation expense accelerated.
Yeah, that was going to be another question. Is like, well, who is this a good fit for? Obviously, it's not for somebody that's not it's not for your primary residence, right? This is going to be for investment property. Now, typically in the commercial space, this is definitely something that we're implementing, right? Like your example there, that we buy multifamily commercial. So of course, we're talking about multi-million-dollar buildings, but is this something that's viable for, let's say, a residential owner, a short-term rental operator, somebody who's just buying, hey, I have a house, I have a rental house. It just makes sense. So I get benefit from this.
So what happened is when I first started back in 2007, for many, many years, probably 10 years, nobody would touch small homes. In other words, if you didn't have a property that wasn't at least $1 million in acquisition cost, nobody would do a cost segregation study. Why? Because we would go out, we'd have to fly out to the property, do all the measurements, and do everything that way. We call that study a detailed engineering study, and we will do that for properties that have a building basis of 750 or higher. We will send somebody out there to do it. And of course, those types of studies cost minimum $1,300 all the way up to $15,000, depending on the complexity of the building. We base our fees on engineering time. So the bigger and more complex the building, the more our fee is going to be. However, nobody could do single family homes or small multifamily that $500,000, $700,000, $600,000 building basis. But we came up with a technique which we call modeling, which is an analytical technique. So we can do those type of studies, and we charge $25 for current year and $675 for look back studies. And don't forget to ask me what a look back study is. But bottom line is now we make it affordable for anybody. You bought a single family home for $150,000. You can afford to do cost segregation now.
Yeah. And that's awesome. Yeah. Now, let's dive into the look back study, because this is powerful, guys. And so this is a great way to go back and see, hey, is there some cash laying around that we can use to maybe take advantage of some stuff potentially, right? So, or some missed opportunities, right? So kind of fill us in. What's the look back?
Well, what happens is that I have a lot of investors who call up crying like, oh, I can't do it because I don't have any properties I bought in 22 or 23 or whatever. Okay, here, and they don't know that we can do look back studies. We can go back, and this is not a bright line. This is a very murky line because we have to do calculations, but I can go back. I like to use 15 years. This is not the age of the property. This is when you bought it. The property could have been built by George Washington. I don't care. It's whenever the person bought the property. So when you acquire the property, you can go back about 15 years. And what we have to do is we have to calculate how much depreciation the client's already taken, because you've been straight lining depreciation for 15 years. How much accelerated depreciation am I going to give them? And then what is my fee? And what I like to use is 10 times my fee. So if I charge you $2,000, I would want to see the taxpayer get at least a $20,000 tax deduction the year. And if they do, then I will tell them to go forward. If they don't, I'll just tell them I don't recommend it, but they can do what they want. But basically the big part of this is you can go back 15 years and I can still give you accelerated depreciation, and the value proposition will work for about 15 years. I've gone back as far as 18 years, but it just depends.
Yeah, no, and that's great. And so like, this is something too, like you can reach out to Joe and ask him, hey, he's going to be a straight shooter here and tell you, look, if this is not worth pursuing because it's not going to be beneficial to you, it's not going to be saving enough money for you, you can get it.
I'll tell them not to do it. I'll tell them, don't do it.
Right.
I'm the first one. I'm their partner in this deal. And I get a lot of calls, and what I do is I just try and make sure they're good candidates. And you know what, Steve, which is really unbelievable, is there's not very many circumstances that they would not make a good decision. I'll give them to you because they're real quick. Number one would be if you did a 1031 exchange and it was a straight exchange. So whatever property you sold and brought into the new acquisition is frozen forever in whatever method you use. So that would be straight line. I can't touch that. So if you bought a property, if you sold the property for $1 million and you bought a new property for $1 million, I would tell you there's nothing for me to accelerate. If you bought a property for $1 million and you sold the property for $1 million and you bought a new property for $1.5 million, I have $500,000 to work with. And we'd have to see, does it make sense for us to do cost seg? But if you sold the property for $1 million and you bought your new one for $2 million, well, now we're talking. And most people, that's the way they orchestrate their exchanges. They trade up. They don't usually stay at $1 million and $1 million. It's usually not worth the pain and suffering. So bottom line is, most of the time we can work with people who do exchanges, but I do have to look at the exchange carefully to see if it makes sense. Number two is the concept of passive versus active. So passive investors are, for example, so they have another primary income, the physician income, and then they're going out and buying real estate. So their active income is that of a physician. Their passive income is that of real estate. There are limitations to the passive investing. We have a lot of passive investors. So the answer is not necessarily no. But if I give you $300,000 worth of depreciation and your maximum depreciation amount is $30,000, I'll probably tell you don't do it. It's going to take you 10 years to go through your $300,000 bucket. And I'll probably say don't. But what if you bought a single family home and your maximum is $30,000? Well, then I'll say do it, because your max is 30. I'm giving you 30. So it makes perfect sense to do cost segregation. The other factor would be if you're not paying income taxes. Obviously, let's get straight. I'm not talking about property taxes. I'm not talking about capital gains. We're only talking about state and federal income taxes. If you're not writing a check to the IRS, you don't need to call Joe. Call me when you do. When your accountant sits you down and says, hey, get your checkbook out. You owe the IRS 15 grand. You say, time out. I'm calling Joe.
Is this something that could still, like, let's say in that situation, and obviously have to be earning enough to be able to even utilize this, but could this be something that they can plant a seed for, let's say in the future, if they have anticipation, hey, I'm going to make some great money here on this thing, where it's like, you can almost bank it, right? Because that's the thing with loft is, right, that you can carry this forward. Again, not tax advice, but this is something that you can kind of, all right, I'm going to tuck this away because I know I'm going to be selling this thing, or have some excess income where I'll be able to utilize it. So it could still be beneficial.
It still could be. And I will give you my opinion. And what I tell everyone is we don't charge for our estimates. We don't charge for the first go around. We must look at the property to see what we're getting ourselves into.
Right.
Again, it's based on time. So I'll look at the property. We'll quote them the fee. And then bottom line is we'll give them the estimate, no cost estimate. And then I'll tell them, take it to your accountant or your tax attorney and just see, does it make sense? I'm not your accountant, so I can't tell you. I can give you my opinion, but if they say don't do it, I say I agree, don't do it.
Right. Yeah. No, absolutely. Yeah. And like I said, you always have the option of, let's say, going and doing a look back study or something along those lines too.
No,
if you
but
don't get a chance.
You did have a good point. as I kind of glossed over it, when I gave the example of a $300,000 bucket of depreciation and I said it'll take you 10 years, that's because these losses are a net operating loss and they carry forward until the bucket's done. So however you use that $300,000, it's always there till you use it all up. And even if you don't have 10 years, you own the property for 5 years, you have, let's say, 150,000 left, you will still use those losses to offset other taxation issues. So you can never really go wrong with cost seg.
Yeah, no, I think it's a winning strategy for sure, especially if you're active and you're wanting to do stuff. I mean, to me, it's a no-brainer, especially because you can have a professional like Joe go out and, again, it's a no cost just to give you an estimate. And this can help to factor into your overall, let's say, investment strategy or tax strategy. Again, because you want something that's cohesive. We wanted all the tools that we can possibly take advantage of to have in the tool belt, right? Yeah, I've got problems to solve. Great. This is a very powerful one that you can use even without, like you said, even without having the bonus depreciation, although that's incredibly powerful too, right? So yeah, kind of wanted to ask you a question too. Hey, you know what? It's time for me to sell the property. I did take these big losses, was able to take advantage of it. It was a great strategy for me. Kind of what happens then? Because I wasn't going to hold it. I didn't hold it for the 27 years, right? I got the bonus depreciation. I was able to take advantage. What happens in that situation where, maybe I do have a fixed liability?
Yeah. So here's what goes on. And this is I forgot what I was going through, why you wouldn't want to do cost seg. The last part of that, the last answer is, I will tell anybody that if you're not going to hold the property for 1.5 to 2 years, don't do it. Now, I do have some flippers who are their IRR is so strong, they feel that they can make benefit out of money they only can hold for a year. But normally I say, look, if you're not going to hold the property for 2 years, it's probably not going to make financial sense to do it. So basically what happens, why I'm giving that advice is because there is a component of the tax law called depreciation recapture. It is a recapture tax. It's 25% of all the depreciation you've taken. So that's why you got to look at that depreciation recapture. And if you hold the property for 1.5 to 2 years, you're still going to come out, in my opinion, okay. Now, how do I come up with that opinion? I speak all over the country. I have a lot of CFOs that I'm on panels with, and I always ask them, what's your opinion? And I've distilled it down to 1.5 to 2 years. But it depends on your internal rate of return. Right. If I give you $1 today and you invest it in a savings account, I'll tell you, don't do cost seg, because you're not going to make any money on the $1 I saved you. So why bother? Just don't do it. So bottom line is, if you have a good IR and you're at 20 or 30%, like a lot of my clients are, then even if you hold on to that money for 2 years or 3 years or whatever it is, you're still going to make money on getting that money up front rather than waiting over time. However, there's one component that I will share with everybody that is not mine. It's from my high-powered tax attorneys, and that is this. Cost segregation reduces depreciation recapture. It does not make it's a reduction effect. Why? Because let's use the concept of a laptop. You bought a laptop 5 years, and I'm using 5 years just for the math. You bought a laptop 5 years ago. What's it worth today? $2,000. You know what it's worth today? Parts. 50, 100, 150. So it's got some residual value, but not much. So the savvy accountant is telling the IRS the same thing. We already know what the 5-year property is because Joe carved it out. 5 years down the road, we sell the property for cash. What's that 5-year property worth? They'll say, let's make up a number, $20,000. They'll tell the IRS it's worth $2,000. And they'll say, take $18,000 off the table for depreciation recapture because that property has been used up. Same thing with the 15-year property. Take off 1/3 of the 15-year property from the depreciation recapture calculations. So unless you understand this concept, you understand the power that cost seg gives you when it comes to depreciation recapture. And there's not very many people out there that really understand this. So I just given you guys a kernel of knowledge that you should put back here to remember. If you sell for cash, if you do an exchange or you pass away, no depreciation recapture, only for cash.
So very powerful, you guys. I mean, so hopefully our listeners are picking up on this conversation that we're having here with Joe and his awesome insight. It's an incredibly powerful strategy. If you're in the right position to be able to use it, there's very few situations. Let's say if you're an active investor where it's not going to be a benefit to you, right? Obviously, Joe's kind of giving us some guidance here on, hey, minimum time pull where it can make sense at 1.5 year to 2 year kind of mark, right? Of course, this is for your investment properties, but gosh, I mean, what a Swiss Army knife in terms of being a very powerful tax strategy. And again, we want to use our capital efficiently and effectively, right? So if you're, just to Joe's point there too, if you're going to go put it and take it out and go put it in a savings account or something like that, where you're just not going to have the return, it's not going to make sense. So, but it's a great way. Hey, if you're active and you're wanting to do more, you want to free up capital to go and do more acquisitions, do more, increase your portfolio size and all that. Yeah. It's an awesome tool. So no, it's a very powerful tool, and we're definitely excited to dive into it a little bit more and give people our insight, because it's not the sexy thing, right? There's no shows on, hey, flip my taxes. Like, as much as I know how beneficial this is, there's no HGTV shows on, right? So, yeah. Well, at this point in the show, Joe's is a time that we transition into what we call our fire round, a little bit more straightforward questions, a little bit more insight into you, and give our audience a little bit more tighter answers there, and some additional wisdom and insight. Is that something you're game for?
Yes, let's go.
All right. Sounds good. What's the best book that you recommend, other than Rich Dad, Poor Dad?
No, I don't know what you mentioned after that, but I do have to say that I think you mentioned it. But I started my journey when it was my stockbroker, who I really respected back in my 20s, who gave me this book called Think and Grow Rich. Yep. And oh my God, that changed my life. That was just like a wow moment. And I really love that book. I would tell anybody, if you have not read it or listened to it on audio, get that book, because it is game changing. And everything about it is game changing, especially the idea of think groups. I'm big advocate of think groups.
Oh yeah, totally. I mean, it's an amazing book. And even if you've heard it or read it before, go through it again. Like, I feel like that stuff is so powerful that we need reminders of it. And especially if you're kind of in your journey as an entrepreneur or as an investor, like, you need reminders. But for certain concepts, you may just not be in a season where you kind of can apply it. You go through it again. It's like, oh man, okay, wow, I can apply that right now. I'm in a different stage than I was when I first read this thing 5 years ago, 10 years, whatever. Yeah. Right. So yeah, excellent book recommendation. You're absolutely right. I love that. What's your next question? What would you consider your superpower is?
My superpower is creating cash flow for my clients. I'm really good at that. I don't care what they do with it, but like you, I tell them buy more property. I tell them fix up your properties, improve your properties. And if you want to take your wife to Europe, okay, you can do that too. But I prefer if they use the money to stay in real estate and increase their wealth.
Yeah, absolutely. That's a great superpower.
Yeah.
All right. What's your next question? What's your biggest lesson that you've learned over your career thus far?
Okay, I'll tell you. And I mentioned it. It was going back to Think and Grow Rich. I am a big advocate. I will stress this. Surround yourself by people who know stuff. In other words, do not get an accountant who works for people who work at Costco. Get an accountant who knows real estate, because they will save you so much. Yeah, they're going to probably charge you more, but they're going to save you so much money, whether it's a financial planner, whether it's an accountant, whether it's a tax attorney, whether it's a mastermind group. I'm a big advocate of mastermind groups, whether it's Steve, whatever it is. Surround yourself by people who are good, honest people who know their stuff.
Yep. No, it's so incredibly powerful. You just don't understand when you walk into a room of other people who are, again, we're like-minded, going back to Think and Grow Rich, right? The concept of mastermind and whatnot. When you have people that are focused on getting better and going, somewhere else, taking it at next level, you want to be around people who are doing that. So yeah, no, absolutely wonderful advice. I mean, it's something that we highly encourage all of our listeners to do. We have a local meetup. And I'm involved with some different masterminds as well. And I know Joe would be as well. So yeah, definitely something you want to take full advantage of. All right. Next question. For the busy working professional who's trying to work towards financial freedom, what advice would you have for them?
Real estate.
There you go.
You know why? Because all my clients are not poor people.
I love that.
Yeah, my clients, they're young puppies, man. And I mean, they're women and men, and I do not know any that are poor.
You know what? And I will say, our listeners, for all of our listeners, my listeners are not poor either. And you know
Good.
what? Because what you're doing, the conversation that we're having here, if you're listening to the conversation that Joe and I are having, right? You're educating yourself. You're getting better, right? And being poor, being rich, it's a mindset first. You'll never get to becoming financially, let's say, wealthy or financially rich without first having that mindset. We're not talking lottery here. This is why lottery winners go back to where they were the vast majority
It
of the
takes hard
time. It's
work.
because they didn't change the mindset, right?
Yep.
So yeah, no, that's great. Well, Joe, hey, if our audience wants to reach out to you, they've got questions, maybe they've got a property that they want to have you dive into, give them a little bit of advice on, what's the best way to reach out to you?
USTAGI, ustagi.com, USTAGI.com. That'll take you to my portal where you can get a call with me or any of my team and talk to them about your situation, get going on the no cost estimate and fee quote and see if it makes sense for you. And if it does, don't forget that you should plan right now. November and December, October, November, December are great months for planning for your taxes for tax year 23. You don't need to do anything now, but now's the time to call Joe and just say, okay, well, how much is it going to cost? Do you recommend me doing it? And get all your ducks in a row. So when the end of the year comes, you can just dive right into it and we can do the cost seg if you decide to go that route.
Awesome. Yeah, definitely. Yeah, reach out to Joe. Like I said, if you got any questions, regarding anything that we've talked about today, or you want to get his latest and greatest book recommendations, or he's on the West Coast and I know he does speaking. So if you want to find out where he's at next and you can see him in person, check out the website, reach out. And Joe, I really appreciate you coming on today, dropping some knowledge, bringing your wisdom and experience here to our listeners. And to me personally, I appreciate you. So thanks again for coming on, and we'll talk to you soon. All right.
Thank you, Steve. Good job.
Great conversation with Joe Viery today over at US Tagging. So awesome conversation. This is a very powerful strategy. This is something that we employ on all of our commercial properties and residential too. It used to be a little cost prohibitive to do that on smaller properties, maybe stuff that wasn't producing as much income as say some of the larger commercial properties. But it has become definitely viable. Obviously, you've got operators in the space like Joe now that can offer it for residential as well. So make sure that you're reaching out. It's a great way to create losses for you. Again, not tax advice, but it's a powerful strategy. And especially because you can go back several years, right? He's got the look back study where he can go back several years to be able to see if you can take advantage of doing a cost segregation and getting some of that that you can carry forward. Again, losses carry forward indefinitely, right? So this is something that you can just kind of bank away, even if you can't maybe take advantage of it in the moment. Just like you said, you can reach out to him, he give you a free estimate to see if it's even going to be worthwhile. If they can't save you enough money right now, totally fine. That's something you can always revisit. There's no cost for that. So make sure that you check him out over at ustaggy.com. All right, guys, if you are looking forward to connecting with people here locally, we talked a little bit about the power of masterminds, the power of connecting with people who are going where you want to, maybe have a little bit more experience than you, a little further down the road. We'd love to connect with you. We've got a Facebook group, Honolulu Multifamily and More. We do a local meetup here every month here in Honolulu. So if you're outer island, if you're on the mainland and you're traveling and you want to connect with people while you're out here, awesome opportunity to do it. We do it every month. You get such a wide range of experience, both from the residential to commercial side, just investing in general. So would love to be able to meet you and put a face to the name, shake a hand, come and have some great conversation about real estate and investing in general. Obviously, if you guys are finding value in these shows, we'd love 5-star reviews. We'd love sharing the show, getting some feedback. We'd love to have more and more guests on that are bringing value like this, like having this conversation with Joe and seeing what kind of value. If nothing else, hopefully that opened up your eyes to maybe some potential opportunities that you weren't realizing. But if that's the case, hey, please share the show. It's the only way we can grow it and we can kind of get more of this knowledge and information and bring value, continue to bring value to you guys. Really appreciate all of our viewers, all of our listeners. Appreciate you guys for tuning in every week. And all right, guys, well, I'll go ahead and sign off for today. We'll see you next time and go out, take some action, and we'll talk to you soon.